So anyway, this is where your stop loss would be, and your entry would be anywhere in here. Now, which price level would you use? You personally. Well, think about the logic. Okay? We're talking about high probability entries, but now we're going to incorporate lower time frames, sub 1 minute. So now we can go into this little range right here. The stop has to be defined right there on that high. Why? Because of the volatility. Now, because of the volatility being so extrapolated and large, we have to consider the formation of the setup time frame for our stop loss. Whereas if we didn't have this wild volatility, then we can go into sub 1 minute in this fair value gap that's shaded here, that's darker. We could use that, and the stop loss could be framed on this swing high in here. And I'll show you what I mean. Let's drop down into, let's go to a 30-second real quick. All right, and that's the business there. You already noticed on the 1 minute chart that the bodies were already staying in the lower half of that fair value gap. So what you want to see is how the market trades into the upper half. You give it a chance to do so. You might miss the trade. It might happen where it goes up there so quick and then starts running away. Well, you missed it. But because you're in the lower time frame setups, there's so many of these forming. We'll go to 9:15, by the way, because I'm not going to be able to talk everything in the time I needed. So you want to try to enter in the lower half. That's your high frequency trading window of entry. The barrier of entry is you need to be inside of this portion of the move. And I know some of you don't like the idea of that. You want to get up here in the upper half. Sure, I do it sometimes, but my experience is a little bit larger and longer than yours. So how do you get in the move and know that you're going to be a part of it and not be afraid that you're going to miss the move? So you want consistency, continuity, but you're also not going to over leverage and over trade. That means use the smallest amount of leverage, 1 micro. You're not looking to make millions of dollars on one trade. You don't care if you get stopped out. In fact, we're going under the premise that you got stopped out overnight in the London session. Now you're using it again. Notice that we're using the high of the volume imbalance on the daily chart because it's a higher time frame PD array. It trades to the high of it. And does it hold that candlestick? Because it opened here and went all the way up here. At one point, there was a big green candle like that. And then it does this, comes down here and closes. Where does it close? Below consequent encroachment. That's this level right here. So now the immediate next candle, anywhere below that midpoint, that consequent encroachment, anywhere in there, but above the low of the candlestick's high, which is the framework of the low of this gap framed on a 1 minute chart. You can enter here. If we were not seeing elevated volatility, you could place the stop loss 1 tick above this high. But because, listen, folks, listen, man, because the volatility is so extreme, because the likelihood of the ranges sharing the previous candle's range, you have to go outside of the immediate smaller time frame price range, which is what we're identifying here. So you got to go back to that 1 minute chart and use the high I showed you. You can't try to trade with these super tight stop losses and not expect to get stopped out a lot. You're going to get stopped out a lot. And commission costs add up. Losses, even though they're small, they will add up. And the frustration, the compounding frustration of you taking small paper cuts, they still hurt, don't they? So getting short up here, aiming for that pool of liquidity right there as a first primary scaling opportunity to take a partial. That would be viewed like this. There's sell side. Entering on a premium. Premium to what? That sell side liquidity pool. And then we have that low. Now, this low is more likely to be a factor because what? What's this dotted line here? That's consequent encroachment of that volume imbalance on the daily chart while being bearish because it rejected the recent highs on the daily chart after NVIDIA earnings. So consequent encroachment is always a draw. Always a draw. It's always a draw. And if we're up here, first partial, doesn't mean you have to take it, but it means that once we get below it, then we want to see displacement. If you're not going to take a partial and you're only trading with one contract, wait for displacement. What does that look like? That. We could create a short-term low, then it dives lower, closes, the next candle starts to run lower. You can see that is displacement. So now you can, instead of taking a partial here, you have one contract, roll your stop loss from where it started over here down to just above that high. So what I just taught you was how, if you're only using one contract and you can't take a partial, because if you take a partial, you're closing the only existing position size you have. So you wait for a key low, which is what I just mapped out here. Not this one, because I want at least 15 handles or I won't take the trade. Once it takes that low out where a partial would be taken, that displacement affords me the opportunity to then move my stop loss just above that high. What high? This candlestick, because this is the displacement candle. And then as it moves lower and lower and lower, we want to see it gravitate to consequent encroachment, which is that big red area from the daily chart. That's that volume imbalance. That's the draw. When it does that, okay, we anticipate it not just trading here, but there's liquidity resting below that. So now we can do this. That's the sell side liquidity pool that you could take a partial or a full closure or wait for it to use that level and displace away from it. Where is that? There. It trades above it here a little bit. Your stop loss, if you were trailing it and you only had one contract, would be here. You're not in jeopardy. You're anticipating this. The market rolls through. Once it leaves this key level on the downside again, you're looking for displacement. Is this displacement? No, it's not displacement because it created this low right there. That low needs to be pierced to the downside. Does it do so? Yes. Does it do so and leave it as a SIBI? Yes, it does. So when it does this, then you can move your stop loss from here down to this candlestick's high because that's the leg that starts the price run lower. This run is sell side delivery, not sell side liquidity. It's the running lower of price action. So that means you put your stop loss right here. So now what you have done is you've captured very close proximity to that low where you would have closed your trade for full target. Remember, you're on a very small time frame and you're using a micro structure approach to trading these price legs. Once this does this, you've afforded getting stopped out, holding the position in case it gives you a little bit more room to run to where? The low of the volume imbalance. Why? Because we're bearish. This little gap in here gets traded up into here and then runs to the low. That would be your next objective. So you can close it there and anticipate some measure of retracement. Why? Because this is a higher time frame daily volume imbalance. It may come back up to consequent encroachment of it. But if we're bearish, we want to see it not do so. Here's where it trades up to here and then rolls over and goes lower. So if you are looking for a larger price run, you can anticipate it retracing back to consequent encroachment. But then if it displaces outside of and below this low, because the displacement has to go below a key low or above a key high. Is this displacement here? Yes. The market trades back up to the low of the volume imbalance on the daily chart, that big red box, and then it moves lower. Once it displaces below that low here and it closes, you can move the stop loss from here down to that candlestick's high. I'm teaching stop loss management. Can you teach stop loss management ICT? Sure. Here you go. And the market trades lower and eventually dives even lower and moves into those targets I gave you this morning where it was gravitating towards an old, smooth little area. Okay, we're getting close proximity of those same time frames. Now, I wasn't on the chart at 5 o'clock in the morning with you all, but you can see how that would be useful here. And once we had displacement below this low leg, that you could trail your stop loss from there down to that candlestick's high. And then you're strangling the position because it's already moved so far outside of the level you anticipated as just a reasonable target.